So what I'm going to discuss today is essentially decentralized finance, and in particular, I will focus on decentralized exchanges. And what I want to do is basically give an overview of what are these type of somewhat exchange that operate over blockchain. What are the mathematical and like technical challenges that one needs to face? And I hope like I can stimulate interest, and I'm looking forward to more discussions about this topic. Let me get started. So I want to start with just a brief introduction about blockchain. I think, I don't know how many of you know what it is, but essentially it's a very involved architecture if one wants to look at the computing details. But overall, what matters for financial transaction is that it's a distributed ledger where everything is happening in a decentralized fashion. In the sense, there is no centralized control. If you want to transact, make a payment, or like do a derivative transactions over blockchain, then what you need to do, you have to submit your transaction and you have to append a fee, because this fee will be used to reward all the validators who will be validating this transaction, will be making sure that this transaction is is correct. And then what happens that the validators who get selected to update the blockchain, which means to append the block, will pick these transactions in order of fees, like in order of decreasing fees. So first it will take the transaction which has paid the highest fee, then the second highest fee, etc. So essentially, if you want to get quick execution, you need to bribe the validators by paying a large fee when you submit the transaction. Okay, so there are two kinds of I like to separate blockchain into two different categories. There are the first generation blockchains, which are essentially payment systems. The idea is that, like borrowing this from the computer science literature, if we have two parties who want to communicate, let's say Alice and Bob, Alice wants to make a payment to Bob. This payment has to go through the network, and the nodes will have to approve this transaction, and will have to route this transaction from Alice to Bob. So essentially, this first generation blockchain were essentially created just to support payment transactions, nothing more than that. But what we have seen in the recent years is this all started in the mid of 2020, so it's a very recent phenomena. There have been a new class of distributed ledgers that have been created, which are sometimes also referred to as second generation blockchains. So what these are essentially, the underlying technologies, basically the smart contracts, and these smart contracts are contractual transactions which are smart, meaning smart means that you have computer programs, and these computer programs will basically determine whether or not some transactions need to be executed, and at what deals, at what terms, and which are the deals when this execution takes place. For example, a smart contract could be a computer program which says exchange 3 stable coins for 1 Ethereum stable coin only if the price of Ethereum has dropped relative to the US dollars by 5%. Like, you can encode this complicated transaction, or you could even like do a sequence of transactions, like do an exchange and then deposit this in a lending pool, etc. And through these smart contracts, where there has been a new ecosystem that has been created, which is typically called DeFi. So DeFi is a buzzword, but essentially what this buzzword means is all financial transactions that we used to see in traditional markets, like lending or borrowing or insurance or managing asset or exchange, etc. Just at this time, everything is happening in a distributed fashion. So transactions are no longer centralized, they are decentralized, and all these services are interconnected to each other through smart contracts. So it's much quicker to like do an exchange and then deposit it in a pool, rather than like splitting these operations into several steps. So the idea is that the DeFi ecosystem, as I mentioned, has grown quite a lot, and like right now it's around 57 billion. So it's still like 10% of the entire capitalization that we see in the digital asset space, but it's growing. And like along the some of the services that are more popular are like this exchange, lending or borrowing derivatives transactions. And there are also oracles which essentially take information from off-chain and input it to on-chain services. And exchange, as you can see, is accounting for roughly half of the entire market capitalization of the transactions. And I mean, along the exchange that are more popular, like we see that Uniswap, SushiSwap, and Pancake swaps, these are the ones that account for most of the transactions. So if you look at the last bar, you see that about 33 plus 28 plus 10% is captured by those exchanges. The names are very funny, like they all have like Pancake, Sushi, etc. But I don't know the historical reason for that. But that's how they are actually working at the moment. Now, let me jump directly into the technical parts of the presentations, which is essentially understanding, first of all, how these decentralized exchanges work. What is the difference with respect to the classical exchange and limit order books? And then, like, I want to study a specific problem within this DeFi exchange, which is the problem of incentivizing market makers or liquidity providers to deposit to those pools. So the basic idea here is to pool liquidity. So the idea is pooling liquidity means that the liquidity providers, they want to deposit tokens on both sides. Suppose that you want to deposit like the USD stablecoin and Ethereum. You hold those two tokens. So what you do, you go ahead and deposit those tokens to a pool. And then, like, I can deposit, Luidgar can deposit, everybody who is part of this pool can deposit tokens. And then we share gains and losses. So we're not competing, we are actually cooperating with each other, because like the idea is that whatever gains or losses we are making, we are all sharing them equally. And then there are investors, who are those who need liquidity. So these are like those who essentially want to get a token from this exchange because they need it for some specific reasons. For example, they might want to execute a specific transactions on the Ethereum blockchain and they need to get the Ethereum token. So what do? They go into this pool and they swap, let's say, one stable coin for Ethereum token, and then they use this Ethereum token for whatever they need to do. And the idea is here that you directly exchange one token for the other. And this is different, or an alternative to selling one token, getting, let's say, the US dollar or the euro, and then use the euro to buy the other token. You can do this atomically, right? You just encode this transaction into the smart contract, and when the validator executes your transaction, it will directly swap one token for the other. Who can deposit tokens in the exchange? Like anybody who owns both tokens actually is allowed to deposit. So the idea is that by depositing, you receive pool tokens, which prove that you are a shareholders of this pool. For example, like if there are currently 100 token A and 10 token B in the pool, and I want to deposit, I need to deposit according to the exchange rate, which is 10 to 1. So I deposit 10 token A and 1 token B, and then I get 4 pool tokens because there are already 40 pool tokens. So I hold 1/11 of the entire share of this pool. So I'm essentially a shareholder. So that means that when I want to leave this pool, I want to take my tokens out, what I have to show is this certificate that I am holding 1/11 of the entire pool, and I will get my tokens, my share of the token. So if the token has evaluated, have appreciated in value, then of course I'm making a gain. Otherwise, I will be losing. And what determines the price is the so-called automated market maker. So the automated market maker is essentially a way to automate the process of market making, and is different from like the traditional market maker because essentially everything is encoded in a function. So the idea is that you want to make sure that both before and after trading, the value of a specific function f is constant, is the same. So let's say, look at this figure, we have currently 10 token A and 10 token B in the pool, right? Suppose that I want to deposit some token A and then want to get some token B out. So if I deposit 5 token A into the pool, then I will basically project this point on the curve and I will get out some token B, and the amount of token B that I get out has to verify this relation, that if the value of the function before trading was 100 because I had 10 token A and 10 token B. Now, after trading, if I deposit 5 token A, I have 15 token A in the pool. So the amount of token B that I can get out has to satisfy the relation that 10 plus 5 times 10 minus delta B has to be equal to 100, which means that I will get out 3.33 tokens, right? I'm depositing 5 and I'm getting less than 5. Whereas in the very beginning, the exchange rate was 1 to 1. So this is already this is basically a manifestation of the so-called price impact that you see in DeFi, because the idea is that every time you trade, if the curve is convex, trading is costly, and as a result, you are not getting out exactly the amount that you would expect. So this is like there is some slippage somehow in the execution. Now, the investors, if they want to trade, they have to pay a fee. And this fee is typically proportional to the amount of tokens that is being deposited. So, for example, if you deposit some token A in the pool, like 10 token A, you have to pay a fee, which is like 0.03% of this 10. This is the current, this fee is the one that is charged by Uniswap, which is the largest decentralized exchange that we have at the moment. So that means that, I mean, when you trade, this is costly because you have to pay a fee. And of course, this fee, what this fee means is that there will be new tokens A, which are created and added to the pool. So that is good for the liquidity provider, right? Because they will basically get a larger amount when they withdraw. If they hold like one liquidity provider holds like 1/2 of the entire pool, if like many investors are trading, then they are paying these fees. These fees increase the number of tokens, and therefore they are increasing the value of these liquidity providers. And that's the whole idea. That's the only reason why liquidity providers want to deposit in the first place, because they hope that through the volume of transactions submitted by traders, they will be able to increase their value. Okay. So there are two main, these are the main characteristics of the centralized exchange. There is this crowdsourcing of liquidity in the sense that all liquidity is pulled together, and the pricing function is not set up optimally through limit orders as the market makers do. Rather, you have this pre-specified pricing function, and the prices are determined based on transactions. So depending on how much trade there is, there will be price impact, and as a result, you will slide towards other points of the curve. So also the liquidity providers are not competing with each other. Any token holder can supply liquidity by depositing. It doesn't need to set prices. So this means that everybody, literally everybody, can be a liquidity provider. As long as you hold a pair of tokens, you can go ahead and deposit them, and then you will be a shareholder of this pool. There is no need to match directly users with each other, like in the sense that you don't have to match, let's say, a limit order with a market order, etc. Rather, you go and trade directly against the pool. So you go there, all these tokens are collected into the pool. You just exchange token based on the exchange rate that is prevailing at the moment. And what is the problem? Of course, seems a very ingenious structure. Like there are some problems, of course, with the design of those exchanges at the moment. And one of the main problem, which is the one we are studying in this paper, is the fact that this pricing rule is very rigid. Like it's just making sure that the value of the function stays the same both before and after trading. As a result, this means that those who are providing liquidity are subject to arbitrage. And I will explain what is the arbitrage. The arbitrage is between transactions that you have on the exchange and those that on the decentralized exchange and those that are happening outside, like the exchange. And because of this arbitrage risk, they will want to reduce the amount that they are depositing. So the idea is that you don't want them to stop providing liquidity, to stop depositing tokens. Otherwise, there will be no transaction. There will be no trade. Like this all infrastructure will not be useful if nobody is providing liquidity. And the key questions that we are answering is basically under what circumstances they would provide liquidity, and maybe also see whether or not there might be situations where they don't provide liquidity in the first place. And the second point is how to design this pricing function so that we maximize both the value of those who are providing liquidity so that they provide liquidity, but also the value of everybody else. Like if we care about this ecosystem to be used to, we want investors to be happy. We want validators also to make enough from fees. And we also want, of course, liquidity providers to be happy and happy. And let's see, the main point is that we will show that this current design is exposing liquidity providers to arbitrage losses. It's raising the cost of liquidity provision. And liquidity, like these liquidity providers will supply liquidity only if the exchange rate of the token is not too volatile. And also what we will see is that depending on the convexity of this pricing curve, this will be really the key determinant of the trading and the provision liquidity. So if this curve is too convex or it's not sufficiently convex, then there will be less incentives to provide liquidity. In fact, like if the curve is too convex, as we will see, there might be no liquidity provided in the first place, so nobody will want to trade. And then we want to design a curve that balances this price impact from trades and the liquidity providers' losses that are being gotten from the arbitrage. So that's like the main literature. And I mean, there is, I think I will skip the literature review for now. The mathematical finance literature is not very well developed in this area, and I'm hoping that like there will be more people working on this topic. It's quite new, so most of the literature comes from either like the traditional market microstructure, like the paper by Budish and Foucault about like sniping in limit order books. There is some evolving literature on blockchain and cryptocurrency, and some literature also on DeFi and decentralized exchanges. But I want to start with the model, which essentially is like a very simple model, just to understand what are the main economic forces in place. And in this, like there will be three main periods in the model. And the main periods are essentially period 1, 2, and 3. And each period, some transaction, something happens and takes place in the market. And then what happens that there are three agents in the model, and these are the liquidity providers. There will be 2 arbitrageurs, and there will be also some investors. And there are 2 types that are being taken because these exchanges are managing pair of tokens, so tokens A and token B. And these tokens, the value of this token is well known to everybody. So there is no adverse selection due to asymmetric information. Everybody observes the value of these tokens, which we can think as the value of, let's say, an Ethereum token or a DAI stable coin, which you observe outside of the exchange. For example, if you go on Binance and you want to transact, you will transact at those prices. So these are different from the price that you see on the automated market maker, because the prices on the automated market maker will depend completely on how many tokens A and B there are. So there will be this difference between price on the exchange and price outside of the exchange. And then at the end of each period, we will see that the transactions that are submitted are executed, and they are executed in decreasing order of fees. So the idea is that the validator will pick the transaction starting from the one which has paid the highest fee, and then the second highest fee, and then third highest fee, etc. And it will be execute this transaction. So if you want to get quick execution, you would better submit a large value at the end of, a large fee associated with it. And these fees are also called gas fees. And the reason why it's called gas is because it's like as if you need some gas to execute this transaction, right? So you are essentially paying for the computational power that you are using. Just to be clear, there are 2 kinds of fees. There are the fees that are paid by the investors who want to trade, and these are just proportional to the amount that they are transacting. And then there are the fees that everybody has to pay if they want to get executed. Like you could always submit a transaction, but if you attach a very low fee to it, maybe this transaction will never get executed. So you will have to wait for a long time. Okay, good. Let me discuss the model. So this is what is happening. There will be liquidity providers will choose which portfolio, they will form a portfolio. So they will decide how much to deposit in the pool and how much to take out of the pool. Then there will be a shock to the value of the tokens, and there will be some investors who can arrive, and this could be either investors who like token A or investors who like token B. And I'm basically looking. This video 2 is the period exactly where the randomness occurs. So these events like shocks to the token or arrival of investors are random events. And then in period 3, there will be the arbitrages, which will exploit this arbitrage. So they will either do the so-called stale price arbitrage, which means that they will profit from the fact that one price has changed, the price outside of the exchange, but the price in the exchange has not, because nobody has traded. And or they could exploit the so-called reverse trade arbitrage, which means trading in the reverse direction as the original investors to gain from the price impact that was imposed by the previous trade. So if they want to avoid those costs, the liquidity providers have to be quick and take their tokens out of the pool. Otherwise, they will basically be suffering a loss. And like the pricing function that we use, I mean, instead of looking at the constant product function that I've shown before, right? The previous pricing function that I have shown was basically fxy is equal to x times y. This is a convex curve, but I want to generalize the model, and I want to capture a broader class of convex pricing function, because convexity is needed, otherwise you wouldn't have price impact. And also, what we see is that the convexity is actually a key design characteristics of those exchanges, as I will show and I will demonstrate in the talk. And the only constraint is that this function is twice continuously differentiable, so I should be able to basically get different, and it has to satisfy this constraint that value of the function before and after the trade has to remain constant. So it's not possible that essentially you trade and then you get a different exchange rate. So delta A is the amount that you deposit, delta B is the amount that you take out. You want to be sure that after depositing and taking out, after swapping token A for token B, or vice versa, the value of the function stays the same. So now if we want to know what is the exchange rate, what we have to do is a very simple application of the implicit function theorem on this curve, and this will give us what is the exchange rate. So in the limit, as you deposit a smaller and smaller amount of token A, the quantity of token B that you get out has to satisfy this relation, that it has to be equal to the ratio of the derivative of the function f at x and y evaluated at the current state of the pool, which consists of token A and token B. Okay. So now I want to relate the convexity with the price impact, which I think is a very important point. So if we look at the slope of this curve, the slope is the negative of the exchange rate. It's minus the derivative of the function at x and the derivative of the function at y. So this gives me the slope of this curve. Now, if I want to look at the price impact, so the price impact here is defined as the difference between the slope after depositing and the slope before depositing. So before depositing, I had the A token. Now, after the deposit, after there has been a deposit of delta A token into the exchange, we have DA plus delta A token A in the pool. So that means that the slope of the function has changed, right? If you go from this red point to 2 to this red point here for 1, the slope has changed. And the difference in slope, taking the absolute value, is essentially the price impact that you are incurring from trading. So this is capturing exactly the cost of trades. And if you apply, of course, the first fundamental theorem of calculus, that means that if you want to look at get an explicit expression for this price impact, this is the integral of the second derivative of the pricing function, right? Evaluated at x, where x ranged between the current amount of deposit and the new amount of depositing after trades. So then what we can see from this expression here is that if you have a larger convexity, which means that G2 is larger, so if the pricing curve is very more convex, the price impact will be larger, which means that it will be more expensive to trade. And we could look at two examples, like the case where there is a linear pricing function. So a linear pricing function, which means the blue dotted curve, this means that there is no price impact, right? Which means that if you want to swap 2 token A, then you will get back 2 token B, right? You get 2 token A, you are to 2, the pool has 2 token A and 2 token B, you deposit 2 token A, so the pool has 4 token A, and you get out exactly 2 token B, so the pool has 0 token B. So in this case, you are not paying any cost for trading. Then the other the situation is when you have the convex pricing curve, for example, the constant product function, where you insist that x times y has to be equal to a constant. In this case, if you swap 2 token A for 1 token B, then you will go from 2 to 4-1, right? And the exchange rate, the marginal exchange rate, is dropping from 1 to 1/4, right? Because now you need to get 1 token A. If you exchange 4 token A, you will get only 1 token B. So this is essentially the relation. So now these are the assumptions that we impose, the only assumption that we have on the pricing function in order to derive the main results about the arbitrage and the provision of liquidity. So we have a function f, which satisfies the following property. First of all, we want that the exchange rate is positive. Remember, the exchange rate is the ratio between the derivative of the function at x and y. So if this, if these are not positive, then it would be weird, because it means that you are basically, if you want to exchange token A for token B, you are depositing token A and you are also depositing token B instead of getting token B. So that's like naturally an assumption that we need to impose. The second assumption is the convexity of the pricing curve. So this means that the higher demand, the convexity of the curve, not the convexity of the function here. So the convexity of the curve means that if you have an higher demand for a token, if, for example, if the demand for token A gets higher, then it means that you need to exchange this token A for a larger amount of token B. So the third property is a kind of positive homogeneity property that we are clearly familiar, like for those of us who have studied like risk measures or coherent risk measure. This comes up as a property here. It's like appearing as well as a defining characteristic of this pricing function. This is the ones that I need to obtain the result, but it also carries a natural economic interpretation, because what it says that like the exchange rate must be invariant to the scaling of tokens that you are depositing. So that means that if you have 5 token A and 10 token B, and you multiply the number of tokens by 2, so instead of 5 and 10, now you have 10 and 20, then you still want to have the same exchange rate. So you don't want to change the exchange rate just based on the on scaling. You want really that the ratio is different for having a different exchange rate. And the fourth property is that I want to support trades at any point. So that means that whatever is the amount of tokens that is available in the pool, whatever is the amount that an investor wants to exchange, there will always be a transaction that takes place. And in order for this to happen, we need this limiting result to hold. So the limit of this ratio of derivatives have to go to infinity or 0. So that means that if, for example, you have you're exchanging a smaller and smaller amount of token A, then the exchange rate has to go to infinity, because f of x, if we think of the pricing function of the constant product function x times y, then f of x will be y, f of y will be x, like the derivative of the function with respect to x is y, the derivative of the function with respect to y is x. So y over x will go to infinity if x goes to 0. So these assumptions are clearly or always satisfied for most of the pricing function that we see implemented by the vast majority of exchanges. So now let me discuss what happens to the liquidity providers. They want to they come into the market and they want to decide how much to deposit and how much to take out. So E is the total amount of tokens that they have. Now they want to split this into the one that they will deposit and the one that they will take out. So D is the amount of tokens that liquidity provider I is depositing, and X is the amount of tokens that liquidity provider I is taking out of the pool. So it's not depositing. And each liquidity provider is a share of the pool, which I'm denoting by WI. And what they want to deposit, want to maximize the total value at the end of the model, at the end of the all periods when the arbitrageurs have already come and executed their trades. So the first quantity, the expected value of this quantity PA3, DA3 plus BP3, DB3 is essentially the value of the transaction, the value of the tokens that is in the pool, right? DA is the one that you have deposited. You deposit today, which is period 1, but then if you then what happens is that there will be trades, there will be arbitrage. So what you get out at the end of the period is not necessarily what you have deposited, right? And also, of course, the prices of these tokens will change. So that's entirely random. So there are two sources around the DA can change and PA can change. Whereas if you take this token outside the pool, the assumption is that you are not doing anything, you're just taking them out, and then you will just observe what is the value, depending on what is the new price of this token A and the new price of token B. And of course, if you want to deposit, you have to pay some transaction fee to the validators, otherwise they will not execute your transaction. So now let me show what happens in the second period, and then I want to go to the third period. So the second period is just where randomness happens. Here I'm constructed a very simple model just to understand what are the key economic forces. So I'm assuming that the token prices are given, essentially shocks, independent shocks that happens like according to a Bernoulli model. So you have two price positive shocks, ZA and ZB. They are all Bernoulli random variable with different parameters, Kn, Kb. And then if there is a positive shock, the price will change by an amount beta. So that means that, for example, if there is a news about a new update to the Ethereum blockchain, for example, because they're not supporting a new service, then the price of the Ethereum token might change. And this is essentially reflected by this positive shock zeta. So that means the price of Ethereum token will change compared to the price of the token when we first started. And this beta, I mean, then I will also link the results of the model to the empirics. So we have looked at the data, and essentially this beta can be viewed as the volatility of the exchange rate. In fact, if you look at the log of PA over PB, you will see that this is a random variable with a 2-point distribution, and the standard deviation is increasing in beta. So if you have a larger beta, there is a larger standard deviation. Now, the other event that can happen is that the investor comes. So there could be an investor who comes and trade. And I'm assuming that there is also a possibility that nobody comes. But the probability cap high, somebody will come. It could be equally likely to be a type A or type B. Like, it doesn't really change much the result if you assume that type A investors are more likely to come than type B, or vice versa. And when the investor comes, they will get some utility from getting this token. For example, a type A investor is really an investor who likes, let's say, the USD stablecoin, because they want to do a digital transaction using the dollar. So that means that they will get this utility alpha from holding this crypto asset, and as a result, they will transact and they will exchange their token for the USD stablecoin. So that's a reduced form model of a utility function that captures exactly the benefit that they extract from holding those tokens. Now, if an investor of type A comes, then he wants to trade, you will have to solve this. This is a constrained convex optimization problem. Essentially, you want to maximize the utility, which it's a linear utility. So the utility from holding token A, plus the fact that you have to pay a fee because if you want to get token A out, you have to deposit token B. So you have to pay a fee proportional to the amount of token B that you're depositing. And of course, you are subject to the rule of the market, which means that the value before and after trading has to remain constant. So it's not possible that you transact according to any arbitrary rule. So the rule is very rigid. I mean, you deposit, you swap token A for token B, but both before and after the trade, the value of the function evaluated the deposits that we have in the pool has to stay the same. So this is the goal. So now let's go to the other part of the model, period where there is an arbitrage. And I first want to illustrate what are the two arbitrage that can take place. One is the so-called stale price arbitrage. So the stale price arbitrage is essentially the fact that the fundamental exchange rate, which again, we can think as the exchange rate of a currency, a crypto token for another outside of this automated market maker, right? This might change, right? Because there are some positive news about one token or negative news about a token, which leads to a change in the exchange rate. And then there is the spot rate, which is the exchange rate within the pool. And this is actually equal to the ratio of the derivative of f at x and y, right? This is what we have discussed before. This essentially is the way that automated market maker is setting the price. Now, if these two quantities deviate, then what is a good strategy to exploit? Well, it's basically the strategy to take out the more valuable token and exchange it for the less valuable token, because that will give me some value. So for example, suppose that there is a positive shock to the price of token B. So token B relative to token A goes from 1 to 2. Then if I want to do an arbitrage, what do? I want to go inside this automated market maker where nothing has happened, right? Because the price has changed outside of the AMM, but the price inside has not changed because nobody has traded yet. So the price is entirely determined by the amount of reserves that we have in the pool. Now, as an arbitrageur, I go and I say swap 5 token A, I will get 3.3 token B, like even if I pay the small fee that is like proportional to the amount of token that I'm exchanging, in this case 5, I will still end up with a positive profit. So this is an example of basically a way to make an arbitrage, that I exchange the more valuable token for the least valuable token inside the automated market maker, and this will give me a value. And I'm essentially profiting from the fact that there is a stale price opportunity, because the price within the automated market maker has not yet adapted, attract the value of the exchange rate outside of the automated market maker, right? And these arbitrageurs are essentially making sure that these prices are converging, right? Because by transacting, they will adjust the price within the automated market maker in a way that the two are close to each other. And this is what what you see in the data, that as soon as there is an opportunity, these arbitrageurs will start trading and then the price will equate. So there is another like type of arbitrage that can occur, which is what I'm calling the reverse trade arbitrage. And this reverse trade arbitrage is the opposite. Now, instead of the exchange rate outside of the pool to change, is the spot rate within the automated market maker to change, right? So this means that somebody has traded. Suppose that there is like a one-to-one exchange rate between token B and token A. An investor comes, there were 2 token A and 2 token B in the pool. Now an investor who wants to transact, he deposits 2 token A in the pool and he gets back 1 token B. So this means that the pool will now have 4 token A and 1 token B. And of course, this trade had a price impact, right? Because of this convexity of the curve. So now what could happen is that if I'm an arbitrager, I could do the reverse trade. I could go back from 4-to-1 to 2-2 and gain somewhat from the price impact that was caused by the previous investor. So for example, an arbitrager can come and now exchange 1 token B for 2 token A so that you go back to the previous state of the pool, which is 2 token A and 2 token B, and this will be profitable. If you look at like the value of this transaction will be positive. So this is the second type of opportunity that you can see, the second type of arbitrage that you can see. Now, when you do the optimization, of course, you are not really distinguishing whether or not it was a state price or a reverse trade arbitrage, but in principle, these are the two main forms of arbitrage that you see. And I'm extracting away from the fact that you might have triangular arbitrage if you transact across different automated market makers. This is just transacting within the same automated market maker. So now, I want to give the main result. Like in the paper, there is a theorem that shows this through the still price first bid. The first price still bid auctions. But the idea is very simple. Whatever the arbitrageurs are making is whatever the liquidity providers are losing, right? Because if I deposit and then somebody trades against me because the token has appreciated in value, is taking value out of me. So it's like transferring wealth from liquidity providers to arbitrageurs. Now, this means that for an arbitrager, suppose that the profit from this opportunity is pi. So how much is he willing to pay to be executed first? Because let's keep in mind that it's very important to be the first to get executed. So he's willing to pay like up to pi, right? So this means that both arbitrageurs will bid pi because they are competing. Like if you bid less than pi, another one will bid more than you, and therefore in the end you will lose all the value, right? You will bid exactly the amount that you would be making from the arbitrage. But this arbitrage cost is split among several liquidity providers, right? Because there is not only one liquidity provider. There are like many liquidity providers. Each liquidity provider is only willing to pay up to the amount that he would save by withdrawing his token. So what's the amount that he would be saving is WI times pi. So whatever loss they are incurring, which is pi, it's split among all of them. So each of them is getting a fraction of his loss. And therefore, they are only willing to bid up to WI times pi. So then it means that this arbitrage is unavoidable, right? Even in the presence of complete information, everybody sees everything. Still, the arbitrageurs are willing to bid more because they will basically gain more from this transaction. So that means that this arbitrage will always occur. No way to avoid it. And one could show that in this model, there exists a unique subgame perfect Nash equilibrium. But let me instead go more towards the results that essentially says that these liquidity providers might even stop providing liquidity, which is what we call the liquidity freeze. And this happens if the exchange rate is very volatile. So if there is a large volatility, which means that this shock that happens to token is large, that means that there is a lot of opportunities to make profits from the arbitrager. So this means that they are willing to basically trade, even though they have to pay a fee for trading. And then therefore, the loss will be so large for the liquidity providers that they will not deposit in the first place. And this threshold at which you stop providing liquidity is actually increasing in the trading volume. So the trading volume is alpha, which is the utility that that the investors are getting, and cap I, which is the probability at which the investor comes. So if there is more trading volume, then you tend to provide more liquidity, right? You defer the liquidation, you defer the liquidity-free threshold to a larger value. So then I think we are like just a few more minutes to discuss what is optimal in terms of constructing this convexity. And the idea is that, as we have seen, like it's all driven by, I mean, most of the reasons why the incentives behind providing liquidity, etc., is determined by the convexity of this curve, right? Convexity of the social price of the curve. So the idea is that if I can act and adjust this convexity, perhaps I can increase the incentives of liquidity providers to deposit, so they will deposit more. Or I could look also at what is the curve that maximizes the benefit of everybody, not just the providers of liquidity, but also the investors and the arbitrageurs, etc. And yeah, in the paper, we have basically solved for the optimal convexity by looking at a linear combination between two different pricing functions. One is the constant product function, x times y, and the other one is the linear pricing function. So the linear pricing function is where there is no price impact, right? Zero, trading is free, so there is no cost. This other one, xy, is like when there is cost for trading. What we want to do actually is solve for the optimal pricing function within the entire class of functions, but we have not been able to do that for now. So we have looked only at the convex combination of those two function, because of course, if we increase k, it means that we are making this curve more convex. So this family of function fk is increasing in k, the convexity of these functions is increasing in k. If k is equal to 0, there is no convexity. If k is equal to 1, then it's the highest possible convex function that I can get within this family. And with this graph, I want to show what is the main idea, which leads to this k star, which is essentially the value of k, which maximizes the benefit of liquidity providers. So if k gets there is the yellow region and the blue region. So the yellow region is the region where the providers, the liquidity providers will deposit. The blue region is when they will not deposit. So as k gets larger, then basically what happens is that the price impact becomes higher. And of course, when the price impact, as the price impact becomes higher, then the gain from a reduced arbitrage is larger than the loss from less fees from investors, because everybody's suffering from price impact, the arbitrageurs, but also the investors. So if you increase k, you make the curve more convex. Not only the arbitrageurs will not want to supply liquidity, but also the investors will not want to trade. But what could happen is that you arrive at a point, which is what I'm denoting by k star, where the benefit from further inducing the arbitrage by increasing the price impact, by increasing the convexity, is actually lower than the loss that you get in the fees, because you are making price impact so large that the investors will not trade, or they will trade very minimal quantities. And as a result, like, you lose more from losing these investors than benefiting from less arbitrage. So that's essentially the reason why you have this optimal k star, which is trading off those two benefits. Now, if you think about the benefit of everybody else, then the convexity should be even lower. So it should be even lower. And the reason is that, like, if you think about what it means to maximize the benefit of everybody, it essentially means maximizing the benefit of the investors, right? Because whatever the liquidity providers are losing is what is being gained by the arbitrageurs, which in turn is what is being given to the miners. So it's not just a transfer of wealth from one to the other. But the investors are really those who are trading because they have benefit from that. So we want to maximize the investors' benefit from trading. And if the price impact is too large, then there are there is a problem that there will be very little quantities that are traded. And on the other hand, if the price impact is too large, then there is also low deposits by the liquidity providers, which means that there will be little quantities that are traded. So because of these two forces, you see that what is optimal to what is socially optimal, which means that maximize the aggregate benefit, is a pricing function which is less convex than the one that would maximize only the benefit of the liquidity providers. So essentially, more convexity is needed to counteract this, the severity of the arbitrage problem, and to incentivize liquidity providers to deposit, especially if the token is very volatile. So if there's more volatility, as there is more volatility in the token, then you need to increase the convexity to counteract this effect. So I just want to quickly mention that essentially what you see, what we have seen is that you need more convexity for unstable pairs than for stable pairs, because for unstable pairs, there is more volatility and therefore more possibility for arbitrage. And if you look at the data, like you look at the main exchange, like Curve is an exchange that is only managing stable coins, and they have a very, a pricing function which is much less convex than the one of Uniswap, right? If you look at Uniswap, is the purple one, and if you look at the Curve function, is the blue one. So that part of the reason, at least part of the explanation for this that is being offered by the model, is that in one case you're managing stable pairs, in the other you're managing unstable pairs. And like empirically, we have also looked at whether or not this is true in the data. Like if you have more volatile tokens, then you reduce the amount of deposits, like because liquidity providers are arbitraged. And also, if you increase the trading volume, if you have more investors depositing, then you increase the amount of tokens that are deposited. And we look at the data from 24 automated market makers. These data are all publicly available, which is one of the nice features of this, this decentralized exchange, that unlike limit order books data, which are typically hard to obtain, here you can get data freely and easily. And 13 of them are from Uniswap, and the rest are from SushiSwap, which are the domain exchange. And then in order to estimate the volatility of prices, we look at data from a centralized exchange, which is the fundamental exchange rate in the model. And the data, the results, like this is a very simple regression where we're regressing the flows, which is the amount that are being deposited, versus the transactions that are being done, which is the trading volume, and the volatility of the exchange rate, the volatility of the pair. And what you see is that, in all three regressions, you see that if you have more volatility, then there will be less deposits that are made to the automated market maker. And on the other hand, if you have more volume of trades, then you will also have that there will be more depositing flow. So more depositors will deposit, which is in line with what we are predicting with the model. And this leads me to the conclusion. The main point here is to show that the current design of these decentralized exchanges is problematic in the sense that the pricing function exposes the liquidity providers to a substantial risk of arbitrage, and that's the reason why some of these exchanges are not being very widely adopted. So the ones that are currently more adopted are the ones that are managing stable pairs. That's precisely because there is less arbitrage to exploit. And if you want to do anything like, or you want to maximize the use of those exchange, one parameters or one characteristics of the functions to act is the convexity of this pricing curve, because this is exactly determining how much deposit there will be, and also what type of what is the price impact that you will incur when you trade. And if you want to also design a curve which is managing or optimizing the aggregate benefit of all participants in this ecosystem, then you have again to balance the price impact from trades with the severity of the arbitrage problem. And this leads me to the end of the presentation. Thank you.
Thank you very much, Agostino. Thank you. Are there any questions or comments from the audience? If you have any questions, you can either type them in the chat, or you can just unmute yourself and ask directly. Berkan, please. There was a hand which has disappeared. Lukasz, please.
Hi. Sorry about that. Is my mic on right now?
Yes, we can hear you. Yeah, thank you.
Okay, sorry. So my question is, maybe this is only due to the simplicity of this model. So the way you've described the model and explained its inner workings, it would seem that it would seem that a few actors can have a disproportionately large impact on the entire market. Is that what happens in reality in decentralized finance, or is that just an idiosyncrasy of the model that you've built? Thank you.
Yeah, thank you for your question. The price impact is exactly depending on the amount of this that is traded. So this is true also in the real data. If you look at let's say family office or proprietary trading firms which transact and they typically exchange large quantities, these are the ones that impose the largest price impact, and therefore they impose the larger costs on the liquidity providers. So that's really, it's not a characteristic of the model. It's really a feature of how this exchange are designed. There are two components that matter. One is the complexity of this pricing curve, and the other one is the depth of the pool. So if you have, let's say, a pool which is very deep, which means that there are many tokens, then even if you have the same convexity as another pool which is shallow, because of the depth of the pool, you will still suffer smaller price impact when you trade compared to the other pool, simply because there are less, the pool is deeper. So any trade will have a smaller impact.
Thank you.
Thank you.
Yeah, okay. So, Martin, hi, Agostino. Thanks for a really interesting talk. I have a question about your conclusion that the gain of arbitrageurs is a loss of liquidity providers. So in what sense? So what I mean concretely is that if I'm a liquidity provider, I put my tokens into the pool, there is, some trade happening, but let's say when the price comes back exactly to the same price at which I provided liquidity, then there is no loss for me. And, I made some gains potentially from the fees.
Yeah, so
where that features in your model.
Yeah, so that what happens that if like in the the idea is that when you transact and like there is let's say if the first type of arbitrage, the sale price arbitrage, this will take value from you. Now, if you do a reverse trade transaction and the price goes back in the same point, it goes back to what it was before, it will never go back exactly where it was, right? Because when you transact, you always impose price impact, and as a result, like the token, the exchange rate that you will be quoted is not exactly the exchange rate at the point where you start the reverse trade arbitrage, because as you transact more and more, the exchange rate will also change. So it's not in the picture. I think you might say, okay, I transact and then I go back, but necessarily when you transact and when you go back, there is always some cost that is paid by the execution.
Okay, thanks. I'll look into the paper for more details.
Thank you very much. Are there any other comments or questions? Sebastian, please.
Hey, Agostino, can you hear me?
Awesome. Yeah, I can hear you.
Great. Yeah, thanks for the talk. I wanted to follow up on Lucas's question, related but different. So you have this 3-period example, right?
Yeah.
Where you and so the universe ends, and so the liquidity provider must enter the market at the start. Oh, well, not must, but can enter the market at the start, and then has to just burn their tokens at the end of this period. But of course, you can continue this over multiple periods, and then do you think the conclusions would remain there? I mean, the example of Lucas where the price would revert back to the pool price, right? The exchange in the the price in the pool. If it reverts back to the price at the start, the LP providers aren't going to lose any tokens there, right? Because the total value, the total amount of tokens that they get when they burn their LP tokens should be in the same ratio as what they started, plus there's extra value that was added into the pool because of the fees along the along that sequence of transactions. So can you comment on this?
Yeah, that's a good question. Like if we look at the dynamics, then of course you're right that if the tokens bounces forth and back, there will be like some essentially the price, the value that is being taken out from the liquidity provider then is being given back somewhat with the reverse trade, and I mean up to this cost that is being paid because of the execution. But certainly, like if we know for sure that if we wait long enough and we find an optimal time to exit, let's say, then the results might slightly be different because exactly what you said, that there might be opportunities for the price to revert back. So it's, as I mentioned, it will never revert exactly back to what it was before because of this price impact, but it can be close to it. So that I cannot answer this question. I think one would have to look at the dynamic model to see whether or not the conclusion would change.